Okay, let's go ahead and get started. Welcome everyone. Good afternoon, and thank you for joining me. Thank you everyone for taking the time out and coming to this very special webinar. Today we're going to be talking about how to utilize credit spreads, specifically on the Nasdaq-100 index options. We're going to go into details about how to trade credit spreads. We're going to get into why the Nasdaq-100 index options are ideal for this specific type of strategy. I'm going to dive into a lot of the fundamental concepts for trading credit spreads, a very in-depth look into how to utilize this strategy correctly. This is a very special webinar. It's taken me quite a bit of time to put this together, and I really want to share this with you. I'm excited to share this content with you, and I want to thank NASDAQ for providing this opportunity to provide this education in this webinar to show you guys how to utilize this very effective strategy on this index that you guys can trade. So for those of you that don't know who I am, my name is Tony Zhang. I am the Chief Strategist here at OptionsPlay. And today what we're really going to get into is an intro to the Nasdaq-100 index, telling you a little bit about what that is, what the product is, and why it's ideal for selling credit spreads. I'll get into an introduction of credit spreads. I'll get into everything from the construction of a credit spread to how to design the strategy, the best practices, and then some trading tips. Now, this webinar does require some basic options knowledge. So if you have some options trading experience, this is really going to help you better understand this webinar. Now, for those of you that are brand new to options trading, I hope this inspires you to take a look at these types of strategies for your portfolio. But really, for those of you that have experience trading, I hope you guys learn something about how to construct credit spreads, better understand how they should be utilized correctly, because they are very different from all other forms of spread trading, especially if you trade debit spreads, or if you buy calls or puts, or if you sell other forms of iron condors or butterflies. Credit spreads are quite unique. So I really want to take the time and help you guys understand the fundamentals of this strategy so that you deploy correctly for your portfolio. Now, the format of this webinar is that it is going to be recorded. I am going to go over quite a number of things here. So the recording is important for those of you that want to take the time out and come back and review the information that we provide. I'm going to spend about 25 minutes going through some of the slides, really diving into the concepts that I want you guys to understand. And then what I'll do is I'll spend about 20 minutes actually showing you some real examples of these spreads with some live prices using OptionsPlay in the last 20 minutes of this webinar. And then at the very end, I'll open this up for Q&A. Chances are everyone's going to have a lot of questions. So I'm just going to ask that you guys hold that off to the end. So I'm just going to put this disclaimer up real quick before we get started. It's basically saying that the contents of this webinar is really for education purposes. This is not a recommendation or solicitation for you to trade any of the securities that we're talking about here today. And everything I'm going to be using here is for illustrative and educational purposes. Now, today what we're going to go over is, number one, I want to start off by talking about the Nasdaq-100 index options, talking about index options as a whole, why the Nasdaq-100 index options are specifically best suited for this type of strategy that we're going to show you guys today, credit spreads. Then we'll dive into the actual construction of a credit spread. I think there are a few different things that I want to make sure everyone understands fundamentally what's different about credit spreads versus other forms of options trading. Then we're going to dive into the actual trading strategy of credit spreads. I'll talk a little bit about the best practices of these types of strategies. And then lastly, I want to talk about or show you guys some real live analysis using different types of strategies that we're going to cover here today during the webinar. Now, for this next piece, I'm going to ask Michelle for a little bit of help here. I just want to do a quick poll here. I want to get a feel for how many people currently trade index options or have experience trading options, trading index options. So Michelle, if you could, so as you can see here, please take a few seconds to answer this poll here. Have you ever traded index options before? Yes, you have. No, I haven't. Or you've never traded options before at all. Just please take a few seconds, answer that question, just so I get a feel for the audience in the room here. Okay, Michelle, could you share with us the results of that poll?
So the results of the poll, to 54% yes, I've traded index options, 43% no, I've traded only stock ETF options, and 4% have not traded any options at all before.
Okay, great. So about 50-50 of you have traded index options. Spectacular. The other half of you that have not traded index options before, hopefully you learned something about why this tool is, so 54% of you have traded, 43 have traded stocks and ETFs only. Great. For those of you that have never traded index options before, this will hopefully help you understand a little bit about what's different about index options versus ETFs and what makes them better suited for credit spread trading. And then for those of you that have never traded options before, I really hope that this helps, inspire you to take a look at options trading as a new form of trading for your portfolio. So thank you, Michelle. So I'll talk, first of all, just introduce the Nasdaq-100 Index itself. The Nasdaq-100 Index consists of 100 plus largest non-financial stocks listed on the Nasdaq stock market. So many of you are familiar with this index. However, I do want to point out that there's the Nasdaq-100 Index and there's also the Nasdaq Composite Index. And I want to make sure that we don't confuse the two. We're specifically talking about the Nasdaq-100 Index. This is the one that has that is generally speaking in the news a little bit more. And for those of you that have traded the Qs ETF, that's tracking the Nasdaq-100 Index. So the Nasdaq-100 Index options are effectively options listed on the actual Nasdaq-100 Index. And there's two indices that you can trade as a trader. You have NDX, which is the full Nasdaq-100 Index. That has currently an index value of roughly 7,500. So you can think of it as almost like trading a stock or ETF that has a value of a $7,500 stock or ETF. Very high value, so very high notional amount. So what Nasdaq has recently created to make a smaller notional value index is the NQX, which is a 1/5 reduced value index, which reduces that index value from 7,500 down to 1,500. So it's like trading a stock that's trading at 1,500. So a little bit closer to Amazon in terms of pricing. So still a large contract, but better suited for retail. This index gives you access to broad-based exposure to the Nasdaq-100 Index. And you trade it the same way you would potentially trade a stock or ETF option. However, these are going to be based off of the Nasdaq-100 Index as opposed to any specific stock or ETF. And this is really suitable for both retail and institutional traders. So that's just a quick introduction as to what the Nasdaq-100 Index options are. Now, I really want to talk a little bit about, for those of you that have never traded index option before, what the true difference is between stock and ETF options versus index options. And index options offers quite a bit of efficiencies in terms of costs and transactions. So first of all, index options are cash settled options. So what this means is that at expiration, you will never ever need to deliver or have to own shares regardless of whether you're long or short the call or a put. So what this means is that whatever profit and loss that you have at expiration is settled in cash. And what this does is it reduces the transaction cost because you don't have to worry about potentially closing a position at expiration to avoid assignment or to avoid having to take delivery of some stock. Everything is settled in cash, so you can open a contract and without closing it, simply have the P&L at the end of the option contract. So it really reduces the transaction cost by not requiring you to necessarily close out a trade at expiration. Second, index options are European style, which means that there's no early assignment risk. So especially for those of you that are selling options and are concerned about an early assignment, you can't be early assigned on an index option, which is really good for selling credit spreads because you have that risk when you're selling a credit spread of early assignment. So removing that risk makes it a lot easier to manage the trade. There is also favorable tax treatment. This is one of the key differences that I think makes it more cost efficient to trade index options versus ETF options, especially if you're trading the Qs, the NDX and NQX contracts give you favorable tax treatment. So only 60% of your gains in the taxable account is taxed at short-term capital gains, but 40% is taxed at long-term capital gains, which means that your effective tax rate on trading index options can only go as high as 23%. So it can potentially give you higher profits if you are trading in a taxable account. And lastly, when you're trading index options, there is no such thing as corporate actions, which reduces the number of gaps, which is really just allowing you to make more trades. Because when you're selling these types of strategies like credit spreads, many times you want to avoid things like earnings, dividends, product announcements, news events, things like that. So you don't have any of that to worry about when you're trading an index option, which just translates to potentially more trades that you can make, more income that, or more premium that you can collect by selling credit spreads. So those are some of the differences between trading ETF versus index options that make it a little bit more efficient when you're trading these types of strategies using index options. Next, for those of you that have traded index options, I want to talk a little bit about some of the research we've been doing recently by comparing NDX versus SPX volatility. And because many of you that have traded index options probably have traded SPX index options. And if you've traded SPX index options, you've probably also sold some credit spreads before. So as you know, when you're selling credit spreads, you want higher implied volatility because that translates to higher premium that you're going to collect on that credit spread. So what we wanted to do is compare NDX versus SPX volatility. We found some pretty interesting data from 2010 to 2017, where we looked at pretty much all different time frames, as well as all different deltas. So regardless of whether you sell very short dated options, or if you sell very long dated options, or if you sell at the money calls and puts, or far out of the money calls and puts, as you can see, on the short end of the spectrum, when you're selling weekly options, the difference between NDX and SPX is about 1.7% in implied vol. NDX is higher than SPX by about 1.7%. When you go out to 2 weeks, that's about 2.2% in terms of implied vol. And anything further, you kind of taper off around 2.3, 2.4. So this is really interesting, so that if you are already trading index options and you're selling these types of credit spreads, it's important to know what kind of volatility are you getting from the products that you're trading. So NDX does provide some higher implied volatilities, which does translate into higher premiums if you're selling these types of strategies. So now that we've kind of discussed a little bit about index options, NDX and index options specifically, let's dive a little bit into credit spreads. What are they? What type of strategy are they? For those of you that are brand new to this strategy, I really want to take a few minutes and break down the strategy so that everyone really truly understands it. So first of all, a credit spread is what we consider a limited risk and reward option strategy that allows you to take a loose directional view on an underlying stock, ETF, or index. So when we're talking about a bullish view on an underlying ETF or index, this is where you would trade a bull put spread. If you're bearish, you would trade a bear call spread. So let's actually look into how to actually construct these so that we can define how to actually trade these in the strategy. So when we're talking about a bull put vertical, so this is the bullish trade that you would make, and sometimes this is called a short put vertical. We're going to use NDX in this example, where NDX is trading at 7,500. What we're going to do is we're going to look at selling a 7,500 put, so an at-the-money put, and collecting an $80 credit for that. For those of you that are familiar with selling puts, you'll know that it's a bullish strategy. But however, just selling the outright put has unlimited risk and requires a significant amount of margin to do so. Chances are many of you may not have the margin or want to take on the amount of risk by selling a naked put on an index like this. So the credit spread really allows you to cap that risk and reduce the amount of margin by simply buying a lower put. So in this example, we're buying a $7,400 put, a lower put, and we're paying a $50 debit on this put. So what that nets out to is an $80 credit by selling the 7,500, a $50 debit by buying the 7,400. That's a net credit of $30. And what that means is that, and as you can see, what I've sold the 7,500, I bought the 7,400. So the width between those two strikes is $100. So what that means is that my max risk on this particular trade is $7,000, because the max reward or the premium that I've collected is $3,000 on this trade. And this is a concept that's really important, understanding the distance between the two widths and the trade-off between risk and reward. And I'm actually going to cover that on the next slide or in a little bit. But that's actually a really important concept to understand, and I'll come back to that one second, but I want to first discuss just how to actually construct one of these trades. So here's an example of a bullish trade that you can make, and you would trade this type of trade if the outlook that you have on NDX is you feel that the index is either going to move a little higher, you'll profit by selling a short put vertical. However, you will actually still profit even if the stock moves, or even if the index moves slightly lower, or if it stays neutral. And this is really why selling credit spreads is a very popular strategy amongst a lot of traders, because you can really make money in a lot of different scenarios, whether the index goes higher, a little lower, or just stays exactly where it is. You can always profit from a bull put vertical. The only time you have losses is if the index really moves significantly lower. That's when you will have losses on this specific trade. So that's again why that's how to construct a bull put vertical and the different outlooks that you will have in order to implement one of these types of trades. So now let's take a look at a bear call vertical. So basically it's the exact opposite. We're still going to use the same example of NDX trading at 7,500. We're going to sell this time a 7,500 call, so an at-the-money call. Let's say we receive an $80 credit for doing so. But just like the other one, a short call, a naked call, is a bearish strategy, but it has unlimited risk and requires a significant amount of margin to do so. So in order to help reduce that risk and reduce the margin requirements, what we're going to do is we're going to buy a higher call against that. We're going to buy a $7,600 call. Same thing, we're going to pay a $50 debit, which brings our net credit down to $30. So we're collecting, again, a $3,000 premium, which is our max reward on this trade. And that means that we're going to risk $7,000 on this trade because the distance between the two strikes is $100. $100 times 100 is $10,000. So whatever we collect in premium, the rest of that is our risk. And I'll just discuss that a little bit in one of the next slides, this relationship between risk to reward when we're selling credit spreads, which is very important. Now, when should you actually implement a bear call vertical? If you expect the index is going to move lower, this is one time that you would consider selling a put vertical, and this strategy will be profitable. However, even if the index moves slightly higher or stays neutral, this strategy will still be profitable. Again, that's why this is one of the more popular trading strategy amongst options traders, because you don't have to have a very strong directional view. And even if the index doesn't move anywhere, you'll still be able to collect some premium. The only time that this strategy will actually suffer losses is if you have a significant move higher in the underlying index. So that's just a quick overview of what a bull put spread is and a bear call vertical is, just so to illustrate these two strategies and when you should consider deploying them. So with that, what I really want to now dive into is actually understanding two fundamental concepts of trading credit spreads, or trading any options really, that is really important to better understanding how to trade the strategy and how to pick the right expirations and strike prices for yourself. So first important concept that I want to go over is the relationship between probability and risk to reward. And I have every single trade that a lot of you that have traded these types of spreads are familiar with the concept of probability of profit. I also have probability of loss, which is basically the inverse of probability of profit. Now, the reason I want to bring up this concept is because I get asked the question a lot, how do I find high probability trades? And before you go off and try to find high probability trades, which always sounds good, you need to first understand the relationship between probability and risk to reward, because the two are inversely correlated. When you have something that has low probability, you're going to have good risk to reward. When you have something with high probability, you're going to get worse risk to reward. And understanding this relationship is really important to helping you decide what strike prices and what credit spreads you decide you're going to sell. And the reason for this is because if you're only looking for high probability trades, you're probably getting really, really bad risk to reward on that trade. And it's not saying that high probability is bad, it's just saying that you must understand both in order to decide which one's best suited for you. You don't want to just search for high probability, and you don't want to just search for good risk to reward. You want to find a balance between the two. So what I have here is two examples. When you're selling credit spreads, you can really sell credit spreads where the strike prices are near the current price, or you can sell credit spreads where the strikes are really far away from the current price. So when you're selling a credit spread that's very close to the current price, what you're generally going to find is much lower probabilities of profit. So usually 60, 70% probability of profit is usually the type of trades that you'll find when you're selling credit spreads that are close to the current price. Now, the trade-off with that, or the benefit of that low probability of profit, is that your risk to reward, generally speaking, is much better. Meaning you're risking usually about $2,000–3,000 for every $1,000 you have in potential rewards on a trade like this. Conversely, for those of you that like these high probability trades, which many of you do, the thing to understand is that, yes, you can absolutely find trades that have 95%, 95, 97, even 99% probability of profit, which sounds really good because you always want to have trades that have high probability of success. However, the downside to that, and it's really important to understand, is that you are risking a substantial amount of money for the potential reward that you're receiving. So many times with these types of trades where you're risking, or where you have probabilities of profit over 90, 95%, you're risking sometimes 10, 20, 30 times the amount that you're collecting in premium on that credit spread. So it's not that that's not good, it's just a matter of making sure you understand the amount of risk, because when you're selling something with a 67% probability of profit and you're collecting $1,000, you could trade 3-4 times and be able to offset one losing trade. However, when you're trading something with 95%, you're collecting $500 at a time. When you're risking $9,500, you would have to trade sometimes 20, 30 winning trades in a row and potentially have that all wiped out by one losing trade. So just understanding that concept and the relationship between the two is really important in helping you decide which strategy is best suited for you. The second most important concept that I want people to understand is the concept of strike selection. So I talked about near the money, far out of the money strikes. The other thing I want to talk about is the width, because the width really determines what I call the opportunity. And the width is the distance between the two strikes, the strikes that you buy and the strike that you sell. So the width is, the opportunity is simply the width multiplied by 100. So for any of you that have traded stocks or ETF options, you're familiar with that each contract is 100 shares. It's the same thing for indices. You multiply by 100, that tells you your opportunity. So when you're selecting your strikes, you have to select two things. Number one, a width, and then you have to select the distance from the current price. So I always tell users to first start by defining your width, defining your opportunity, because the rest will come from the distance from the current price. Now, again, when we're talking about selling near the money strikes, you're going to get better risk reward with lower probability of profit. When you're selling farther out of the money strikes, you're going to get worse risk reward with a high probability of profit. Now, the thing to really understand for credit spreads is that once you define your opportunity simply is the risk plus the premium that you receive. And the part that you have control over is the premium that you receive by selecting the distance away from the current price. When you select strikes that are close to the current price, you have high premiums, which means lower risk. If you're selecting very far strikes, then you have low premiums, which results in a higher amount of risk. So once you've defined your width, that is your opportunity, and that has been defined. And what you have control over is how much premium you're going to receive by selecting how far away the strikes are. So the closer you are, the higher the premium that you receive, the smaller the risk. The lower the premium you receive, the higher the risk. So that's a really important relationship to understand. So when you're selecting your credit spreads, think about two things. Number one, how far apart are the two strikes? That defines my opportunity. And then how far away from the current prices? That defines how much premium you actually receive. So those are the two factors that you need to decide when you're selecting which credit spreads that you're going to sell on the underlying index. So next, what I want to talk about is the specific strategy. When do you actually deploy a credit spread? One of the great things about trading credit spreads is that you can deploy them much more often than many other option trading strategies. Similar to selling cover calls, you can do them pretty much all the time. So it's just a matter of defining when is the right time to enter a credit spread strategy. That's what I want to help you guys define here today. So first of all, when we're talking about picking expiration dates, this is where selling credit spreads is fairly straightforward, because when you're selling credit spreads on index options, for the most part, you generally want to keep your expirations very, very short. Weekly options, anywhere from 1 to 3 weeks out, is typically where we see most credit spreads traded on indices like NDX. So, and the reason for this is because short-dated options really maximize theta. That's what you're looking for when you're selling credit spreads. You want to maximize theta or time decay, and that happens in the last few weeks before expiration. So that's why you usually choose very short-dated options. So that's pretty straightforward, and that's pretty across the board regardless of what type of trader you are. When it comes to selecting strikes, this is where it really differs. Like I said, you can choose very high probability strikes or you can choose very low probability strikes. And depending on what your views are on the market, you select the one that's appropriate for you. So to help you figure out which ones you should choose, what I've put out here is really two ways of thinking about this. Number one, you can either have a strong directional view on the underlying index. So you either feel that the index is going to move higher or the index is going to move lower. That's really where you want to trade near the money credit spreads, because this near the money credit spreads gives you higher delta, which is more sensitive moves in the underlying index. That allows you to take advantage of that directional view to some degree. However, there are plenty of users that sell credit spreads that effectively have no directional view. This is really for those of you that have no directional view and you just simply want to collect some premium. This is where you want to sell far out of the money credit spreads. So those high probability credit spreads. And the reason for this is because when you sell these far out of the money credit spreads, you have a very low delta on those trades. So you're not very sensitive to the moves in the underlying index. So we'll go over some real examples, putting the two side by side, near the money strikes and far out of the money strikes, so that you can actually see the difference and how the underlying index affects these strategies. So that helps you kind of define or gives you that framework of deciding what strikes should I choose when you're selling your credit spread. So I have two examples here, just for illustrative purposes, and we're going to go through OptionsPlay in a few minutes and show you guys these strategies. But selling a near the money strike is, like I said, a lower probability of profit trade, but has a significantly better risk reward. This is really like the first example that I gave you with the put strategy, where we're selling an at the money put, selling a 7,500 put, receiving an $80 credit, buying a lower put against that, paying 50 bucks for it, and having a net credit of $30. So again, this has an opportunity of $10,000 because the distance between the two strikes is 100. 100 times 100 is $10,000. That's your opportunity. Your max reward here is the credit that you receive. So the $30 or the $3,000 in credits that you receive is your max reward. Your max risk is the rest of that opportunity. So the difference between 3,000 and 10,000 is 7,000. So that's your max risk. And the probability of profit on these types of trades is usually in the 60% range, 60, 65% range. These are the types of numbers that you should be used to seeing when you're selling these near the money strikes. Conversely, if you're selling far out of the money strikes, these are the high probability trades with significantly worse risk rewards. What these types of trade looks like is you're typically selling, number one, a far out of the money put. So a put that already is very far out of the money. So instead of collecting $80 in premium, you're only collecting maybe roughly about $10 to $15 in credits. You're going to buy an even lower put against that, and it's going to cost you only a few bucks to do that, about $8 in this particular case, and what you're going to receive is a net credit of $7. Now, the opportunity here on this trade, as you can see, is $20,000 because the distance between these two strikes is $200. So you have a $20,000 opportunity, but you're only collecting $700 in premium on this particular trade, which means that you have $19,000 of risk on this particular trade. Now, when you look at these numbers, they don't look particularly good, but what really attracts people to these types of trades is the probability of profit on these trades are really, really high. Sometimes you can find 95, 97% of probability of profit. Now, what's interesting, or at least what I find interesting, is that these types of strategies, these far out of the money strikes, is actually where we see a lot of index option credit spread traders typically trade. We actually saw a trade yesterday of about a little over 400 contracts on NDX traded, where someone risked about $8 million to collect about $100,000 in premium. And that trade had about a 98% probability of profit. So and these types of trades, like I said, you don't even have to have a directional view, because you're basically saying that I don't think the index is going to move 3 standard deviations lower over the next couple of weeks, which is a completely valid way of trading as well. Just if you're going to make these trades, make sure you understand what is your max reward, what is your max risk, and make sure you're comfortable with those types of risks before you go ahead and trade them. But I do want to illustrate that if you look at the large trades, the large prints that happen on these index options, they tend to be more on this side of the spectrum, where these are really high probability trades with really poor risk to reward ratios. So when do you actually enter one of these trades? Now, generally speaking, for those of you that sell credit spreads, and this is again where I'm going to ask Michelle to help me with another poll. Michelle, could you put up the poll about how many people use technical analysis and charting for their trading? What I really want to understand is, oh, sorry, the next poll. I apologize. I want to understand how many of you guys actually utilize technical analysis and charting in your trading. So, you know, a lot of you said about 95% of you said you trade options. So I'm curious as to what percentage of you use technical analysis and how many of you use other forms of analysis in your trading when you're utilizing options. So let's see, what are the results here? Okay, so 82% of you say you use technical analysis or charting in your trading. And about 20% of you said you use other forms of analysis. So great. So most of you do, and for those of you that do not use technical analysis, you may end up using more of those really high probability trades where you don't have a true directional view, or maybe you have other ways of figuring out your directional views. But the idea is that when you want to utilize credit spreads, generally speaking, they're best used when you have overbought or oversold conditions. Now, these are for those of you that use these technical indicators like RSI, MACD, stochastics, Williams percent R. These types of overbought, oversold indicators are really ideal for entering credit spreads. Now, for those of you that use these types of indicators, just please use the chat window and type what type of technical indicators you use in your trading, because that's really going to help us frame kind of looking at this next slide. I'm curious as to if you guys use RSI or stochastics or maybe other forms of trading to determine overbought, oversold. Just type them into the chat window. The other thing that you can utilize credit spreads for is if you've identified double tops, double bottoms. So a lot of times you will have support or resistance levels where you feel the stock's going to bounce, or an index is going to bounce off support or resistance. These are all ideal times to enter these types of credit spreads, meaning you have a relatively loose directional view where you feel the stock's not going to continue moving in one direction. It may reverse, but it may not necessarily go too far in that other direction, but you certainly feel that it's not going to continue going in one direction or another. So the only thing that I want to point out is that when you're using credit spreads, you do not generally want to use this when you are expecting a large move. So meaning if you feel that an index or a stock is about to break out and it's going to make a big move in one direction or another, there are better strategies for that, like buying a call or a put, or even trading a debit spread, that are generally better for capturing a large move. Credit spreads, generally speaking, are more so for a neutral or modest move in the underlying stock. So if you felt that that an index is oversold and you're bullish on that stock, you would want to sell the put credit spread. If you felt that an index is overbought and you're bearish on it, you want to sell the call credit spread. So I'm looking through the chat, and it looks like many of you use, I'm just reading here in the chat window, looks like a lot of you use MACD, a lot of you use stochastics, Bollinger Bands, moving averages. So a lot of these types of indicators, and many of them do relatively the same thing. They're just different calculations for trying to gauge overbought, oversold. So what I have here is just a quick chart. This is NDX, the Nasdaq-100 Index. What I have here on the bottom is a very standard stochastic indicator. For many of you that have used the indicators that you guys have put in the chat window, I'm guessing most of you are familiar with this. Every time the stochastic indicator gets to oversold, these are ideal conditions to potentially enter a bull put credit spread. So as you can see, when the stochastic gets oversold, this is when you want to enter a bull put spread over and over again. And this is really one of the key differences between trading credit spreads versus other forms of trading, is that credit spreads is ideal for trading the same index or ETF or stock over and over again. Unlike trading calls and puts or debit spreads, it's something that you typically enter on different stocks all the time or different indices all the time. So specifically with trading credit spreads, this is why when we look at the volume or what people trade on NDX, it's primarily credit spreads, because it really allows you to trade one strategy over and over again on the same asset. Conversely, if let's say you were overbought, or if the same indicators were saying overbought, these are times to enter a bear call credit spread. So every time the stochastic indicator gives you that sell signal, that's when you can enter a call credit spread. And you can actually string the calls and puts together. So as you can see, I've identified oversold here, so I can potentially sell a put credit spread there. And then once it reaches here, I might sell a call credit spread. Even if my put credit spread hasn't even expired yet, I can enter my call credit spread here. So you can actually string these together. And this is really why index options is really ideal for selling credit spreads, because you can do these over and over again. You don't have to worry about corporate actions. They're all cash settled. There's no, they're all European style, so you don't have to worry about early assignment. You can just do them over and over again. Every single time an indicator gets overbought, you sell a call credit spread. Every time it's oversold, you sell a put credit spread. So with that, what I want to do is just leave you guys with a few trading tips and then really move on to showing you some real strategies using OptionsPlay. So talking about timing, like I said, we want to time credit spread entries with overbought, oversold, or if you use support and resistance or any form of analysis or charting that gives you an idea as far as the stock's not going to continue going in one direction or another, those are ideal times to enter a credit spread. Like I said, you can string puts and call verticals together, which is one of the great things about selling credit spreads, is you can do it over and over again on the same underlying. The strategy itself, between selling calls and puts, we do tend to see more put trades on this type of strategy than we do on calls. And that's really because puts generate more premium, and because puts have a higher implied vol, that's why, generally speaking, for the most part, we do see more volume on puts than we do see on calls for credit spreads, especially in these index options. And for those of you, depending on your account value, you want to make sure you choose the correct index. So we talked about NDX as the full Nasdaq-100 index. This is an index that has a value of roughly 7,500 right now. This is suitable more so for the larger accounts, or maybe even for institutional traders. And then for NQX, which is a reduced value index, it is the exact same index, but just 1/5 the value. This is more suitable for smaller accounts. So we'll go through an example of both when we're showing you guys this on OptionsPlay, but just a quick, a few tips on trading these if you're going to enter these trades selling credit spreads. Now, the last piece that I want to go over before we start looking at OptionsPlay is risk management. So with any form of options trading, the key is risk management. So when to take profit, when to cut losses, these are things that you should have planned ahead before you enter the trade, so you know exactly when you're going to take profit, when you're going to cut your losses, and when you're going to hold the trade until expiration. Now, with selling credit spreads, the goal is simply just to sell the credit spread, let it expire worthless, keep that credit, and do it over and over again. That's the goal. And however, what we do find is that based on all of our back testing of these types of strategies, even though the goal here is to let the credit spread expire worthless, but we have found that it does make sense to take profits early if you've made more than 50% of your profits on that credit spread and you have more than a week left to go on a credit spread. That is usually a good time to just take profits and maybe sell another credit spread instead of holding that on to that credit spread for that last couple of weeks and trying to still collect the roughly 30 or 40% profit that's left to make. It's better to take those profits when you're ahead and sell another credit spread. On the other side, you should also have a plan for if the trade goes against you. So talking about cutting losses, So this is really talking about how much premium you've received with respect to the vertical width. So if you're selling those near the money credit spreads where you're collecting more than 20% of the vertical width, this is where you want to cut your losses, where your trade has lost about 75 to 100% of the credit that you've received on that trade. If you're selling those really far out of the money credit spreads where you have a high probability of profit, this is really where the premium you receive is less than 20% of the vertical width. This is where you want to cut your losses when you've lost more than 100 to 200% of the credit that you receive. These are some risk management tools that can help you avoid those really, really large losses, especially on those high probability trades where you do have quite a bit of exposure to the downside. Making sure that you have a plan for cutting your losses early will help prevent blowups in your account. So those are some of the keys or the rule of thumbs that you should keep when you're selling these types of credit spreads in terms of risk management, which is really key for you for long-term success for these types of strategies. So let's now go ahead and jump over to OptionsPlay, and let's actually take a look at some real trading examples to show you different credit spreads and show you how they actually perform through different conditions. So for those of you that have never seen OptionsPlay, welcome. This is a tool that's designed to help make your options trading as easy, as intuitive as possible, and really allow you to compare different strategies side by side. Now, we created this platform, we started this company about 5 years ago because we realized that when you start on a page that looks like this, that gives you all the strikes, all the calls and puts with all the numbers on it. Number one, if you're new to this type of trading, this is a lot of data to look at, and sometimes it's not really informative, and sometimes it's really difficult to understand where to start. And even for those of you that have experience using option chains or very familiar with using option chains, there's a lot of things that it doesn't provide you with, like how do I compare one spread to the next spread, or how do I compare one expiration to another, or what if the index goes down by 10%, how much do I make or how much do I lose? These are the types of analytics that you need in order to decide which credit spreads to sell. That's why we created OptionsPlay. We wanted to put all of those metrics in your fingertips while still allowing you to navigate through the chain. So that's what I'm gonna want to show you guys here today. So what we have here is trade ideas and watch lists here on the left. We have our security analysis panel here in the middle, and then we have trading and income here on the right. This is designed to really provide you with all the tools that you need to decide what strategies to deploy on any stock or ETF using options. So what I have here, I've already constructed, I have the Nasdaq-100 index. This is the full Nasdaq-100 index. I'll pull up the reduced value in 1 second. But what I have here is I've set up 3 credit spreads. And this is the credit spreads that we refer to, the near the money credit spread here on the left and the really far out of the money credit spread here on the right. As you can see, the probability of profits increases. The near the money has about a 58% probability of profit. The one in the middle has about a 70% probability of profit, and the one on the right here has an 81% probability of profit. As you can see, each one of these that I've set up are $100 wide. So the opportunity here is $10,000 in each one. I created that specifically for the reason to help you guys compare the 3 side by side. So the 74.50 by the 75.50, which is effectively selling the at the money and buying back a put that's $100 less than the current price, will collect about $2,600 out of that $10,000 opportunity. The one in the middle will collect roughly $2,000, so risking $8,000 on this particular trade, and the one on the right will collect about $1,000 and risk about $9,000 on the trade. So as you can see, these are the 3 possibilities that you can, or the range of possibilities that you can do. So what I want to now do is use the P&L simulator, which gives you an idea as far as if the index goes higher, if the index goes lower, how much money do you actually make from each one of these strategies? How much money do you actually risk from each one of these strategies? So I'm pulling up bullish strategies on NDX because I was looking at the stochastic indicator, which is what we were looking at before. And as you can see, we talked about here, every time it reached oversold, it's a good time to enter a put credit spread. It was oversold here in the end of July. It was oversold here at the beginning of August. And it looks like it's about oversold here, and it's just starting to turn around here. So I think now is actually a pretty ideal time to consider entering a put credit spread. So here, from my perspective, I have a fairly strong directional view on this particular trade. So I would typically choose a strategy here on the right-hand side because I'm fairly confident that NDX is going to start moving a little higher, or at least it's not going to move much lower. So what I have here is I've created the scenario of what happens if NDX stays exactly where it is. What happens if it stays around 75.50? As you can see, all three strategies will provide me with profit. So if I sold this credit spread here on the right, I make a $2,600 profit. If I sold this middle one, $1,900, one on the right, $960. So this really allows me to take advantage of these profits if the index stays where it is or moves higher. However, what happens if the index moves lower? That's really where these strategies will start to differ. So as you can see, if the index goes down to, let's say, 7,500, here I've lost $2,300 on this trade. So this is really where my at the money or near the money credit spread will actually start to underperform if I'm wrong on my analysis, versus the other two will still collect that $1,900 and the $1,000 respectively. So this is really where if you're selling these near the money or if these far out of the money credit spreads, even if the index value doesn't go in the direction you expect it to, you're still likely going to make some money. And as you can see, if the index continues to go lower, that's when it starts to change. So really the index has to go down to 7,400, and this is the September 21st expiration, which is only 8 days away. So chances are the index isn't going to decline 2 standard deviations over that short period of time, but you can use this tool to quickly look at what are the expected losses of each one of these strategies and how far does the index need to go in order for me to reach that. So as you can see, I can quickly determine exactly where my expected outcome is on NDX. So I'm maybe expecting this to go back up to its 52-week high around 7,600. So from that perspective, if it does go up to 7,600, I would prefer to sell this near the money credit spread because I'm going to get a nice $2,600 in premium versus only $1,900 or only $960. However, I do understand that my risks to the downside, and this is really where you have to ask yourself, where do I feel NDX is going to go? How strongly do I feel that way? If I feel fairly strongly that this index will continue to go higher, then you might want to trade this strategy here on the left. But if you feel that there's a fairly good chance that maybe the index value will drop, let's say you think it'll drop down to 7,400, then exactly where my losses are, where my returns are. So as you can see, if it goes up to, let's say, 7,500, even if it goes down to 7,500, I probably prefer to trade this strategy here in the middle. And this is really designed to help you play around and try out the different strikes and use the P&L simulator so that you can quickly decide which strategy is best suited for you based on your outlook on the underlying index. So this is, and you can use this to modify this. You can change the strikes. You can move the strikes down one. You can move the strikes up one. This really allows you to play around. Like I said, what I usually like to do is first define my opportunity by determining the distance between the two widths, and then moving the strikes either further away from the current price to collect less premium with higher probability, or move the strikes closer to the current price, which allows me to collect more premium with a lower probability. And understanding that relationship really helps you determine which strikes that you select for your given strategy. So with that, what I'm going to do is I'm going to now flip this over to NQX for those of you who are interested in trading a smaller index value. Just to give you a quick snapshot, I'm going to set up 3 strategies as well. We're going to look at bullish. We're going to look at the short put vertical. I'm going to change this to the same September 21st expiration. And let's say I'm using a 20-point spread here. So I'm defining my opportunity to 20 points. So I'm risking $2,000. The total opportunity here is $2,000. And what I'm going to see is I'm going to see how much money I can collect in terms of premium. So if I sold the at the money put and bought a put $20 lower, I'm going to collect $560. And that means I'm going to risk $1,400. So then we can also put up a similar type spread. Same $20 opportunity, but let's say we go a little further out of the money. Selling the 1,500 put and buying the 1,480. And then we'll do the same thing here on the right, really allowing you to see the flexibility of this platform. And maybe this one we're going to sell a really far out of the money. Let's say we sell the 1,480, buy the 1,460. So as you can see, each one of these has an opportunity of $2,000. One will collect $560, one will collect $370, and one will collect roughly $160. One of the things that you can also do with this tool is, as you can see, everything is shaded green and red. That's based on the index staying within a 1 standard deviation range. So you can use our trading range simulator and actually change the expected range that you think the index will trade in, and that will help you determine your strikes visually. You can actually move your strikes up or down one without having to use the strike drop downs, which sometimes is really nothing more than an educated guess at best, versus if you use our trading range simulator, which determines where you think the index will trade in, you can actually use this to visually figure out exactly which strikes to sell. So as you can see, I can sell this 1475, 1455, which will only give me profits if the index stays within the range that I expect. So this gives me a 90% probability, but I'm only going to collect $130 for an $1,800 risk. So then I can go back to my P&L simulator. I can decide where I think the stock or the index will end up on expiration in 8 days. So it's currently at 14 or 1512 right now. So what if I think it's going to go up to 1520? Same thing as you can see on this stochastic indicator, it's just overbought, starting to turn around. So I'm a little bullish on this particular trade. And keep in mind, this is by no means a solicitation to trade this. This is simply just for illustrative purposes. This is designed to give you an idea as to really comparing different strategies and seeing what the expected profit is if the index stays where it is or moves a little higher, and if it moves lower, exactly how much losses will you expect. As you can see here, the index can really move all the way down to 1476, which is down here, 1476, and still this strategy here on the right will be profitable. This strategy really needs to take a substantial nosedive, or the index really has to take a substantial nosedive over the next 8 days for this strategy here on the right to have this $1,800 loss. And that's really why we have a 90% probability, because it requires severe move in order for this trade here on the right to have that $1,800 loss. So again, perhaps that's why more people like to trade this strategy here on the right. And like I said, there's not one strategy that's better than the other. It's more about understanding exactly which strategy is best for which views that you have on the underlying stock. So if your outlook is you're quite bullish on this index, you generally want to trade the strategy here on the right. The strategy here on the left. And if you don't really have a directional view and you just want to collect something premium, then you could look at the strategy here on the right, as long as you understand the potential risks if the index does pull back substantially over the next 8 days and when you sell these types of credit spreads. So with that, that is everything that I wanted to cover with you. I wanted to show you guys, first of all, introduce the Nasdaq-100 Index Options to you and understand why they are suitable for this type of strategy. I hope you guys were able to really learn something about the construction of credit spreads and understand really the two core concepts, the relationship between probability and risk reward, as well as the distance between the two strikes and how that changes with respect to the distance from the current price to define your opportunity, and then looking at the risk reward within that opportunity, looking at near the money strikes all the way to far out of the money strikes, understanding the difference and the outlooks of the underlying index and when you should deploy each one of these strategies. I hope I was able to illustrate that to you guys here with OptionsPlay. And for those of you that have not used OptionsPlay, we do have a special offer for those of you that want to take a look at this tool. We have a free 30-day trial, as well as a lot of options education webinars, just like the one we've done here with the 20% discount to OptionsPlay if you go to optionsplay.com/income. So with that, I just want to thank everyone for taking the time out this afternoon. At this point, what I'm going to do is I'm going to open this up for Q&A. Looks like I have quite a few questions already here in the queue, so I'm going to take as much time as I can and answer as many questions here. So please, whatever questions you have, please type them into either the chat window or the Q&A window, and I will answer as many questions as I can. So, which has the best liquidity? So at this point, NDX certainly will have higher liquidity. NQX is a relatively new contract that just launched. So if you're trading these NQX, I do recommend that you use limit orders for that. With NDX, you can still use market orders for those types of trades. So there is certainly going to be more liquidity on NDX versus NQX at the moment. Kevin saying, Kevin, so that question about pulling NDX up at your broker, that's a question for your broker. You should be able to call them up, and sometimes depending on the broker, they have different symbols for the index options. So please call your broker and they should be able to help you out with that. Jerry, thank you so much. I really appreciate that. Michael's asking, can the spread be closed prior to expiration? Absolutely. So even though these are European cash settled index, you can close them the same way you do a stock or ETF option. So the trading of them remain the same. It's just that it's a little easier to manage around expirations, in my opinion, because of the fact they're cash settled and they're European style. Is that a delta of 0.08? James is asking. James, if you can tell me which one you're referring to, but if you're talking about those far out of the money credit spreads, absolutely. That's what we see. We see a lot of credit spreads traded where, you know, they're selling the 10 delta and buying back the 5 delta. So these are exactly what I mean. These are very low delta trades, so that these have very low exposure to the underlying index. So these far out of the monies have very low deltas, very little sensitivity to the underlying index. So it doesn't matter if the index moves higher, moves lower, you generally are able to take a profit on these types of trades. Explain opportunity. I hope I was able to explain opportunity. It's simply the distance between the width multiplied by 100. That's your total amount of money that you're playing with. And then how much risk, how much of that opportunity is risk and how much of that opportunity is reward is determined by how far away from the current price you're selecting your strikes. I use Chaikin good for overbought, oversold. Yeah, so any of these indicators that you guys all put in here, these are all good indicators. It's not like one is better than the other. They're really all designed to do the same thing. They're just different calculations. Can you show the chain to see how you select the strikes? So you certainly can use the chain. So I can click here on modify and look at the whole strikes. But I would argue that if you're just looking at the chain, it's really difficult to decide which strikes you want to use. That's why we use a more visual approach. As you can see, I've already used my one standard deviation move. So let's go back to one standard deviation. That allows me to select my strikes visually so that I can select strikes that only have profits within a one standard deviation range. That, in my opinion, is a much better way to go about selecting your strikes than simply looking at a drop-down menu, because when I'm looking at this drop-down menu, I don't really know where to start. It's a best guess, and I usually have to pick one, look at the analytics, see if it's something I want to do, then you go back to the chains. So you end up doing a lot of back and forth, and that's why we created this tool that allows you to navigate the whole chain without and navigate it visually, and that's really one of the reasons why we created this platform. Which product is very liquid in bid-ask spreads, and how do you manage the trade if it goes against? So, like I said, the NDX is more liquid in terms of bid-ask spreads, and how to manage them. That's really what I was covering here in this particular slide of taking profits early if you made more than 50% profits and you have at least a week to go, and cutting your losses depending on. And it's a different strategy depending on whether you're selling these high probability credit spreads or low probability credit spreads. There's different ways to manage your risk on the downside. And these are the general rules of thumb for doing that. Jacob's asking, how do you calculate the OptionsPlay score and what does it concretely mean? Great question. So we have what's called an OptionsPlay score. This is a score that tells you the risk to reward of each strategy based on the outlook that you, or based on it's a risk to reward ratio, and it's meant to give you the insight of the same mentality of a poker player, meaning how much reward am I getting for every unit of risk that I'm taking? And it's basically assuming that the index can either go higher or lower. It doesn't have a directional view, and it's saying what are your potential risks and what are your potential rewards. And it's really calculated based on where you think the index will end up. So as you can see, if you think the index will take a very wide range, it will recalculate your risk reward ratio. If you think that it's going to trade in a very narrow range, it'll recalculate your risk reward ratio. So if you expect NQX to trade in a very narrow range, this strategy here on the right will give you very good risk reward, meaning it'll only give you reward and almost no risk on this particular trade. So this is really where it's designed to give you a way to actually compare different strategies side by side and give you a way to metric to give you a good idea of risk to reward. Terry's asking, can you show what the trade button does for constructing the actual trade? Great question. So for those of you that are actually looking to trade these strategies, when you hit the trade button, it'll give you the details on how to enter this trade into your broker's platform. This is designed to give you a quick understanding of how to enter these trades into your broker's platform. So this is designed to be broker agnostic, so you can use this for any form of trading. James is asking, do you use delta for a probability indicator? So we don't use delta. We actually calculate our own probabilities of profit, but delta is usually a pretty good approximation if you don't have your own probability calculations or if your platform doesn't provide that. How are probabilities for using iron condors on NQX? So it's the same thing so you can think of an iron condor as putting a put credit spread and a call credit spread together. That's really what an iron condor is. However, I would argue that you don't necessarily want to trade iron condors because we talked about you want to put on a put credit spread when it's oversold. You want to put on a call credit spread when it's overbought. Now, I don't know why you would put on an iron condor, which is a bull and call spread at the same time, because you can't really be bullish and bearish on the same stock. Nor do I think there's any real analysis that tells you the index or the stock is not going to move at all. So that's why we, generally speaking, you can leg into an iron condor. You can sell a put credit spread today and maybe sell a call credit spread a few days later, and combine that ends up being an iron condor. But we generally don't believe that you should enter iron condor as a single strategy. It just simply doesn't make sense because you're effectively saying, I think the index or stock is overbought and oversold at the exact same time, which obviously can't be true. So that's my thoughts on trading iron condors. If you want to trade them, leg into the put and call legs separate. Does OptionsPlay support butterflies and broken wing butterflies? Absolutely. You can set up all types of strategies. So if you want to look at condors, butterflies, all of these, you can do that. You can set them up by the click of a mouse. And if you want to do broken wings, you can certainly do that. So you can do all types of strategies here using OptionsPlay. What is the advantage of trading NQX as opposed to the Qs? Great question. So the difference between NQX and the Qs is, like I said, with trading index options, you have quite a few efficiencies. When you're trading ETFs, when you're trading ETFs, they're not cash settled, which means that you could potentially need to close out a trade before expiration and avoid assignment at expiration, which increases your transaction costs. They are American style, which means that they can be exercised early. So you always have that risk when you're selling a credit spread that you might end up owning the stock or have to deliver the stock because you got an early expiration. There is no favorable tax treatment on trading the Qs. And so those are three main, in my opinion, advantages to trading NDX and NQX versus just trading the Qs. Tom's asking, on the OptionsPlay idea screen, there's an OptionsPlay logo sometimes appear next to the stock symbol. Great question, Tom. So that's really referring to stocks that hit multiple scans. So ADTN hit multiple bullish scans for that day. That's why it's got an OptionsPlay score. I'm happy to answer more questions about OptionsPlay, but I want to keep the questions for this Q&A session to more on the index options piece. If you have a specific questions about OptionsPlay, please sign up for a free trial, and I'm happy to answer as many questions specifically regarding OptionsPlay. I have a question here. NQX weekly options volume looks so small. Why we pick NQX to trade options? So NQX is a brand new product, which explains why the options volume and open interest is so low, but that doesn't necessarily mean that you can't trade it. So a lot of people mistake liquidity with open interest and volume. Open interest and volume just refers to if other people are trading it. It really doesn't have much factor in liquidity. So something can have very little volume, but still have plenty of liquidity, which is really what you're looking for in a product. So make sure you don't confuse the two. NQX is a brand new product, so there's not as much volume and open interest in it yet. When you're talking about taxation, are you talking about Canadian or US traders? I'm talking about US traders. First of all, this was good education. Thank you. Enlightening and definitely worth implementing. Can you send me some ideas on NDX while we are learning to implement this index option trading? So keep in mind that this is not a solicitation to trade NDX. This is more purely for educational purposes. But if you're looking for ideas, the best way to do is using your charts. So we talked about using the charts. Whenever you feel that the stock is oversold, using one of these overbought, oversold indicators, that's good time to consider entering one of these trades. So use that as your starting point. If you're just starting out with these, start with 1 or 2 contracts at first, but that is a really good starting point for those of you that are looking questions, ask us, and that will be able to allow you to ask us any questions you have regarding trading strategies. Rose, the expiration on 2018 September 21st AM. What does the AM mean? Really, really good question. So there is, on the NDX, there are still AM and PM expirations. The AM expirations refer to contracts that actually stop trading on Thursday afternoon instead of Friday afternoon, and they're settled based on the Friday opening price. So for those of you that are trading index options or first-time index options, that is one of the differences between trading index options versus ETF or stock options, because stock options all expire on Friday and settle based on the Friday closing price. On the NDX, the monthly expirations are still AM settlement. So they stop trading on Thursday afternoon at 4:15, and they are settled based on the Friday opening price. Is there options idea scanner and options play? So yes, we have a lot of other tools and things that are available to you within options play. But today, like I said, I want to direct our questions specifically regarding trading NDX and credit spreads. If you have a question about options play, please sign up for a free trial, and I'm happy to answer as many questions as you have. Do you offer annual subscriptions? Absolutely, we do. I have a question here. RUT and SPX weeklies are easier to trade than NDX in my opinion. Then 10 to 16 days to expiration may be easier than 7 days to expiration. So there's all different types of expirations. If you're simply talking about expirations, you can choose the 15-day expiration here on NDX as well. So we do certainly have the 10 to 16-day expirations on. So basically we have the weeklies here as well. So you can trade them just as easily as you do on Russell and SPX. Gary, I'm a regular user. This tool makes my analysis much easier. Thank you for presenting this today. Thank you, Gary. I really appreciate this. James, what do you consider a small account and large? So I would say a small account is if you're having, if you're trading options and you have less than $25,000 to play with, that is what I would consider a smaller account for options. A large account is really anything over $100,000 in my opinion. That's when you can start playing around with NDX. Anything less than 100,000 in your options trading account, you're probably better suited for an NQX contract. Irina, thank you very much. I really appreciate this. James is asking monthly versus weekly. James, if you could clarify what you mean by that question, I'm happy to answer that. Dina's asking, Tony, will you be sending out a copy of the presentation to us? Yes, so I'll send out the slides to all Options Play subscribers. Or I'm sorry, if you have an Options Play account, you will receive the slides that I'm presenting here today. So if you have a free trial, you'll also get that as well. What is the recommended days to expiration for NDX and NQX? Great question. So we've covered this before, but basically you want to stay within those weekly expirations. 1 to 3 weeks out is generally speaking where you want to sell credit spreads. That's the majority of where credit spreads are sold, is in that 1 to 3 weeks out. James, okay, great. I'm glad I answered that question. I have a question here. James is asking, volume was low. If I'm guessing you're referring to NQX on that question? Oh, you mean volume in terms of audio. James, this webinar is recorded, so if you have trouble listening to us right now, hopefully the recording will work out for you as well. Okay, any other questions regarding trading credit spreads or NDX or NQX? Thank you, Tom. Thank you, Jerry. I really appreciate this. Before I sign off, any more questions regarding trading credit spreads? Raymond, thank you very much. I really appreciate it. I hope you guys have found this presentation useful. Like I said, really, if you're interested in selling credit spreads, and half of you say you sell credit spreads, but on stocks and ETFs, some of you may not have known the benefits of trading index options versus ETF options when it's selling credit spreads. The fact that it's cash settled, European style, and the favorable tax treatment really is a huge benefit for users that are selling credit spreads. So if you're doing this on the Qs, or if you're doing this on stocks, take a look at index options. Even if you don't trade them all the time, it's an interesting product to take a look at because it does provide those additional efficiencies in terms of costs and transactions. Peter's asking, so index trades will always go to full term? I don't know what you mean by full term. If you mean full term, so from a trading perspective, they are exactly the same as ETF and index and stock options, meaning you can open and close them whenever you'd like. The only difference is at expiration, index options are settled in cash. So you never have to worry about delivering shares or taking delivery of shares. It's just all settled in cash. It's just easier and cleaner at expiration, and you don't have to worry about early assignment. So in my opinion, when you're selling credit spreads, those are two things that are pretty important in determining how to manage that trade, and index options just makes that process that much easier. Tim, thank you very much. I really appreciate that. In regards to your question about the data, please shoot me an email at info@optionsplay.com. I'm happy to answer your questions to that as well. So for any of you that have questions about anything that we talked here before, after this, you can email us at info@optionsplay.com. Del, thank you so much. I really appreciate this. I hope you guys have found this useful. Any last questions before I sign off for the day? If not, I just want to thank everyone again for taking the time out this afternoon. This was a very special webinar for me. I was really happy to put this together, and I want to thank Nasdaq for having me and allowing me to present this specific topic. I think it's a great strategy for those of you that are looking or already implementing credit spreads to take a look at NDX, and for those of you that are already trading index options like SPX to take a look at NDX because of the higher implied volatility. And I really hope that you guys learn something new when it comes to selling credit spreads, even for those of you that have implemented these strategies, since I know I have done credit spread webinars in the past. And I do think that I've dived into a little deeper in some of the concepts, especially that relationship between the width and the distance between the current price and the strikes. Very, very important concept if you're trading credit spreads. So I hope that you guys learn something new and are able to implement it in your trading, especially if you're using OptionsPlay. So thank you everyone for taking the time out this afternoon. We will be back in about a month. I'll be doing another NDX webinar. We'll be talking about how to hedge your portfolio using NDX options. So please make sure that you sign up for that. I'm looking forward to seeing you all then next time. So thank you everyone. Have a great afternoon. I hope you guys learned something on this webinar. Thanks.